Hello everyone, it's Wednesday, December 17. Today we will analyze the charts for the euro and the British pound to assess potential market moves. The euro strengthened yesterday, supported by weaker than expected US labor data. Sterling followed a similar path, posting a solid bullish run. The US unemployment rate rose to 4.6%, reaching its highest level in more than 4 years, which underscored continued deterioration in the labor market. Non-farm payrolls increased by 64,000 in November, following a sharp downward revision of 105,000 in October. These figures reinforced expectations that the Federal Reserve may need to expand its bond buying program or accelerate interest rate cuts. US retail sales, meanwhile, were virtually unchanged in October and offered little support for the dollar. Additional data on US services and manufacturing activity showed readings that were stronger than those in the euro area, but still pointed to emerging weaknesses, adding further pressure on the greenback. Nevertheless, some investors chose to lock in profits in euro long positions, while others took advantage of attractive dollar levels. This helped offset the dollar's losses. As a result, both the euro and the British pound ended the session lower, with a decline extending into the Asian trading hours today. The price action reflects a shift in market positioning. After the bullish trend that began in late November, the number of traders willing to buy the dollar on dips is increasing, despite yesterday's disappointing jobs report. After all, in the context of the recent US government shutdown, many market participants had already braced for weak labor figures. Now let's take a look at today's macroeconomic calendar. In early trade, the spotlight will be on UK consumer price data for November. Forecasts suggest monthly inflation will be flat after a 0.4% increase in October, while the annual rate is expected to ease to 3.5% from 3.6%. Even so, inflation remains well above the Bank of England's 2% target. As a result, Thursday's BOE interest rate decision could prove particularly challenging, especially if today's inflation data comes in stronger than expected. The euro area will also publish consumer price data, with headline inflation expected at 2.2% and core inflation forecast at 2.4%. With both figures seen in line with consensus, the European Central Bank is likely to remain comfortable with its current policy stance. Investors will also be watching Germany's IFO survey, including business climate, current conditions, and expectations. Any upside surprise could lend support to the euro. In the US, the macroeconomic calendar is relatively light. Traders may only take notice of scheduled remarks from Federal Reserve officials John Williams and Raphael Bostic. Turning to today's technical analysis, the 1-hour EUR/USD chart shows a sharp decline that has erased the gains from Monday and Tuesday. In this context, buyers may step in around 1.1716. A false breakout at this level, triggered by positive data from the euro area, would generate a buy signal, pushing the euro towards 1750. A break in consolidation above 1750 could open the way to 1776, with further upside possible toward 1.1801. At this level, I would recommend going short on the rebound, targeting a 20-25 pip move. Short entries at 1776 and 1750 should be taken in case of a false breakout. On the downside, if buying interest remains limited, a break below 1716 could trigger a sell-off, with the euro sliding to 1.1684 and potentially reaching 1.1649. At this mark, it would be prudent to go long on a rebound, aiming for a 30-35 pip move. Long positions at 1684 and 1716 would only be relevant after a false breakout. As for the British pound, gains appear unlikely today, with market direction closely tied to upcoming UK data. A spike in consumer prices could trigger a false breakout at 33.84, potentially pushing sterling toward 34.21 and even 34.52. Strong inflation would have notable implications for the Bank of England's rate-cutting path. The most distant target in this scenario would be 34.90, where it would be wise to go short on the rebound, counting on an intraday correction of 30-35 pips. Short positions at 34.21 and 34.52 should only be considered on a false breakout. Conversely, if the data points to easing inflation, the pound is likely to slip to 1.3384. Consolidation below this level would generate a sell signal, opening the way to 33.56 and potentially 1.3322. At this level, long positions on a rebound could be appropriate, targeting a 25-30 pip move. Long entries at 33.56 and 33.84 would only be relevant following a false breakout. Best of luck to everyone.